for President Trump at the moment, but markets are really rolling with it. We had US stocks hitting a record high overnight, and that is feeding through to some more optimism for S&P futures at the moment as well. Futures, when it comes to this part of the world, Japan, South Korea, Hong Kong, all higher in the early part of the Friday session. We're seeing the optimism for 0.6% higher for Sydney stocks as well, which is quite interesting given that we have seen that market as being perhaps a little bit subdued given the recent fall in oil prices. But speaking of Japan, Japanese trading house Mitsui looking to invest in liquefied natural gas projects across the Middle East, the US and Australia to meet rising power demand from AI data centers.
What up, y'all?
Speaking exclusively to Bloomberg,
in.
CEO Kenichi Hori also called for an urgent reopening of the Strait of Hormuz.
Yes, we need to make sure that the safe passage of vessels is resumed, and the Middle Eastern countries are going to continue to be the critical suppliers of energy products to the global markets. We cannot forecast when that will be resumed, but we just hope that we see an early recovery there.
What will give you confidence?
Safe passage of the vessels and geopolitical stability.
In the meantime, your U.S. gas business is a big driver of earnings at the moment.
Yes.
How are you doing there?
At the moment, it's
That was like a political
doing
answer
as
right there.
planned.
He should have been more specific.
A little bit above our plan. We do have investment in shale gas itself. We also have investment in the liquefaction facilities. So it uses U.S. natural gas converted into LNG. We also have chemical plants that convert the natural gas into gas chemicals, such as methanol and ammonia. And we have vessels, dedicated vessels lined up for the export part of these molecules, and also for LNG. So it's a long supply chain, and it starts from the natural gas produced in North America.
Is your business there enough, or do you have more plans for expansion?
Always looking for expansion opportunities, yes.
In what sectors and where?
In LNG, and also for the gas chemicals that I talked about. We are working on a ammonia project. The sequesters its carbon emissions, so it's a clean ammonia. That's another project that we're working on in the United States.
How big is your U.S. business compared to the rest of your of Mitsui, and what's the plan of like expansion?
The U.S. business represents more than a quarter of our net earnings at the moment, and our policy is to our plan is to expand it further. How
has the war in Iran and various geopolitical flashpoints around the world in recent years perhaps changed the global energy dynamics when a lot of these issues such as sanctions perhaps are being put on the back burner because the world desperately needs
I have my patio open.
The world desperately needs fuel, and the world needs to have more production sites that are reliable and competitive. So this is now an equation of trying to add more sources, and the Middle Eastern sources will continue to be very important. I think it will continue to be critical to the global supply. And with this with the situation in Iran at the moment, the long-term supply-demand situation will tighten. That means that we need to have various projects that are in the works now to be completed. So
situated there.
The energy industry can continue to meet
airflow
the rising
going on
demand
here.
For energy.
Which is why you're traveling so much. I mean, before we started this conversation, you were telling me you're going to Australia, you're going to Latin America, Europe, so forth. So where are you diversifying?
Yes, we're diversifying into all parts of the world. For our LNG business, of course,
specifically
Middle East, North America, Australia, and Africa.
In the LNG business, but that's not what she asked you, bro.
The bright spot for our business is that for energy, there's a clear demand for growth. With the
you haven't changed the subject.
Data centers and the necessary energy for compute, clean, affordable, and sustainable energy is really key. In order to make that happen, we need to be part of good projects that have a lot of quality reserves. So we're fortunate to be in such situations in some of our assets. So I think we're in the right direction.
Because for these power-hungry data centers, perhaps, as you mentioned, the advent of artificial intelligence, we are seeing some governments also trying to rein in these exports, like Australia when it comes to gas from 2027. Do you expect more governments to try to keep their energy security within their borders, and what would that mean for Mitsui?
I think the governments, most governments, are very true to the commitments they made to the global markets. So for their export permits and for their export activities, and I think it's also natural that the players are mindful of domestic demand as well. Mitsui in Australia works on both ends. We also develop gas for Australian domestic use, and also we export gas for LNG. So I think for us, we like this balanced approach.
That's Mitsui CEO Kenichi Hori speaking exclusively to our colleague Sherry-Ann in Tokyo. And you can check out the Bloomberg Video Hub. Subscribers can explore live streaming, news and interviews, all our Bloomberg.
Anyway, what up, y'all? It's the KRISTOPHER. It's the KW podcast. This is Christopher Whitney speaking. And today we're looking at the morning calls, as I call them. Bloomberg Intelligence gives us a heads up. And that way you can get your trades organized ahead of the trading day. And I'm here to share this with you. If you are a trader, if you're someone who finds this interesting like I do, then you are in the right place, because I have a wealth of information on this. I've been trading since 1997 when they first came out with online trading. It used to be dial-up. I remember America Online. You got mail. So we had TD Ameritrade. It just used to be Ameritrade until TD bought it out. But Ameritrade, it was a dial-up online trading platform. You could trade stocks on there, just like you do now. And that's when I started. It was fascinating to me. Anyway, the show is not about me, though. I'm just letting you know that I have a lot of experience. Most of my peers are a lot older in age, so don't let the younger looks fool you here. Yeah, so I've heard. Now, some days I look pretty rough, but these days are looking good, my friends. The market hit all-time high on optimism that the ceasefire will continue. Looks like Iran's government is finally waking up and smelling the coffee. I mean, they don't have any viable way to negotiate, really. And Trump is being pretty lenient considering the circumstances. I think they should need to hurry up and wrap this up already. Everyone's they're done with it. Market's priced it in. Anyways, we're back to the program. Let's check it out.
By another 60 days. President Trump hasn't agreed to that yet, but we understand it's under consideration. And moreover, it is just optimism that the work continues when it comes to ending the war that has really ignited that oil-driven surge in global inflation, right? Take a look at what we're seeing with the dollar, which really, at this point, is not much. But in the context of it having just hit in the session a 7-week high on a trade-weighted basis.
So over the last 6 Citadel weeks, says market.
Sort of relative.
We'll talk about that in a minute.
That we are going to see a resolution to the Middle East conflict. What we are now seeing is that Bloomberg dollar really maintaining that resilience. Still, though, positioning potentially still reflecting a softer dollar view through the fact that we're seeing still some rate differentials perhaps coming back into play here. The 10-year yield still at 4.5%, and still potentially that first round energy inflation still seeing that pass through just when it comes to the inflation numbers, the consumer numbers the PCE data that we had suggesting there is some softening when it comes to the US consumer right at the start of that key summer season there as well. Treasury is there on the rise as we see that geopolitical optimism and the possibility of a breakthrough. Also, that key US inflation gauge rising less than expected there. 0.4% overall was the PCE number, 0.2 once you remove food and energy, lower than what the markets and economists had been expecting. Well, the St. Louis Fed president says policymakers need to be open to a possibility of an interest rate hike given current economic conditions. Alberto Musallam told us that he agrees with Fed officials who wanted to drop the easing bias from the April statement.
Their real policy rate right now is running at around 0.5%, which is lower than the 1% that the committee believes is
St. Louis
the neutral
Fed.
rate. I think you have to look at the full picture, and it looks to me like policy is at or slightly below the committee's long-run neutral level.
But if you combine that with the other things you talk about, you had emphasized the risks of the inflationary pressures on the demand side and the supply side of the economy. It sounds like you think they should be leaning towards tightening. It sounds like you might have been one of the policymakers in the April meeting who actually thought they should have removed the statement against tightening in the statement.
So yes, I supported the interest rate decision, but I thought the easing bias was no longer consistent with the outlook and the balance of risks, which in my mind, the balance of risk has shifted a little bit towards the inflation side and less towards the employment side. Whether the economy will require a hike or a cut or a hold will depend on the scenario. There is a scenario where inflation remains high. There's no disinflation in the next quarter or two.
This guy's on point.
Scenario, the economy will probably require a hike. There's also a scenario where the economy weakens materially in the second half of the year because real incomes are challenged and corporate margins are challenged. In that scenario, inflation could come down. In that scenario, we would be thinking of no hikes, maybe even a cut. So there are two scenarios to play with here.
But looking down the track, at least the markets are now fully pricing a rate hike by March 2027. Given where we are now, how we think things are going to proceed with oil prices and some of the risks on the supply side that you talk about, do you think that's a sensible thing for them to price?
Again, I think there are two scenarios here, and I don't comment normally on market pricing. I'm more focused on what's best for the economy and for Main Street. Markets have repriced materially in the U.S. and in other countries in the front end of the curve. I think that's markets trying to understand what our reaction function is.
He's a Fed
St. Louis Fed President Alberto Musallam there speaking with Bloomberg's
he can't speculate
at the Reykjavik Economic Conference.
It's against their
Let's take a
religion.
look at the yen. Suffice to say, it's still pretty weak,
Right.
knocking
Yen,
on the door of
suffice to say.
160 at the moment. And Tokyo inflation
Knocking
for
on
May
the
had been a
door,
short time ago.
160.
Not really doing anything to support it either. The key inflation gauge cooling to the slowest pace in 4 years. That's going to make life a bit more difficult for the Bank of Japan, which was hoping to normalize rates, but the current pace of inflation suggesting that window may be closing, Heidi.
Yeah. We are also sort of gauging the path for the BOJ ahead, right? It kind of, the inflation numbers showing that perhaps some of these official programs successfully easing the cost of living issue there. Policymakers still very, very much wary as to what we see from the impact of energy prices and the war in Iran. We are getting some more data just crossing the Bloomberg when it comes to retail sales year on year. We're seeing really a beat, 2.1% high. Expectations were for 1.3%.
It boils down to the oil once again.
Of 1.3% against expectations of less than 0.5%. Department store supermarket sales seeing a gain of 2%. We're also getting factory production data as well. Industrial production there seeing a gain of 0.8%, really bucking the expectations of a contraction of 0.6%, and year on year a gain of 2.3%. So some pretty positive data there when it comes to both the consumer side as well as the industrial production side, adding to the picture when it comes to the key inflation gauge for Tokyo cooling to the slowest pace in 4 years. Complicated messaging for the Bank of Japan. This is Bloomberg.
it on Bloomberg Open Interest.
Okay, y'all. We got like 4 minutes left on the program. Just to sum up a couple things. Basically, everything is boiling down to oil. The yen, oil. The Bank of Japan, policy trying to normalize in jeopardy, oil. We got Musallam, Alberto Musallam, St. Louis Fed. And St. Louis Fed is, if you ever go to their website and listen to their audio series, they have a great audio recording of the author of The Wealth of Nations himself, the founder of capitalism, founder of our whole global economy system, basically. They modeled the entire Constitution over. Anyways, he is saying that the easing bias no longer consistent with risk. So he's saying that the Fed may not be able to have the capacity to cut rates, which they need to. And the problem with that is that the interest expense on the government debt has now exceeded the defense budget as a line item in the budget. So Congress is now having to contest with that. We had one party who was in power run up the national debt 40% basically, which has really made it difficult to manage this inflation. China has actually been helping us, and inflation has come down, but with the war, once again, oil is the Achilles heel here. Oil is the number one driver of inflation because, as you know, oil has been incorporated into everything because even though capitalism is the best, in my opinion, and if history is any indication, probably the best form of government, and that's the current majority form of government in the world, our global economy is based on, but it's not perfect, just like anything. But it's not as bad as, say, socialism, for instance, who has a zero historic success rate if you backtest it. So I'm not saying it's perfect. But the point is that our leaders in certain industries have, gone corrupt. And that corruption has led to planned obsolescence and suppression of technologies and a bunch of things like that. But compared to the substitute, the other options even worse. So that stuff can get snuffed out. We got the right people in place now to handle that, and they're doing a good job. And so to offset this ridiculous debt, we've also uncovered almost $1 trillion in fraud. So that's like the $1 trillion, I believe the federal budget deficit. And if we go to cbo.gov here, this is right here. It shows you, just take a look at this for a second, if you would. Debt held by the public as a percentage of our gross domestic product. So if you take all our output from our economy, and then you put that into a unit of measurement, say dollars, and then you compare that to the total amount of the debt, and they say held by the public, that means public institutions that are government debt, government bonds, treasuries. In Japan, they're called JGBs. And anyway, so notice something here. Look at that debt just spike up. It jumped up, boom, 1910. Okay, so there was some sort of conflict there. I believe that was World War I. And then shit chilled out. And, we had the Great Depression, I believe. We had the Roaring 20s. But then, boom, that's when World War II kicked in. And then things started to chill out, and then it just escalated. Whoa, 120%. When you break 100%, that's when things start getting dicey. 100% debt to GDP for a country generally is when you're at the tipping point, where if you're a mathematician, if you see the curve, there's a thing called an inflection point. That's when it's going to take off. And that's the inverse inflection point, that's not a logarithmic one. Is that the point where like a wildfire goes from a little brush fire to out of control prairie fire is spreading fast. So we don't want it to reach a critical mass. The debt situation is at a critical point, and I don't know this to be a fact, but it's like they wanted that. It's like they tried to do that on purpose. Like they were trying to destruct the system so they could recreate it in the way they wanted it. And sorry, guys, better luck next time, but that ain't going to work. Eventually people are going to have woken up to it, and that's not cool. Okay. Stop trying to push your ideology on us, and, just be real, like cut it out, right, y'all? Anyways, it's not a political channel, but politics is like about 30% of decision making when it comes to investments, markets, and such. So, anyways, back to what I was saying here. Markets rally to all-time high in optimism over ceasefire, over Iran, government deal. Then we got Citadel Securities. Citadel, who is run by Ken Griffen himself. This guy is slick. He is slick. And he's got connections high up. But he did make a fortune on his payment for order flow scheme, which he got in trouble for. But anyway, that was under a regulatory body. There's too much to talk about in the subject here, but the bottom line is, my whole point here is that if Ken Griffen is behind that Citadel security call, they didn't say his name, they used personification. They said Citadel. Citadel says markets are pricing signs of Iran deal. Of course, Citadel can't speak because Citadel is a corporation, an entity, not a person. But what they're really saying is, if you read between the lines, is that Ken Griffen, the CEO of Citadel, with his connections in the government, is saying that he already knows something that we don't know, and that the deal is probably already it's already agreed on. It's going to happen now. So he's not, in my experience, his calls have been on point, and he's not very liking of Trump. Let's just put it that way. He's been very critical of Trump. So for him to say something that's affirming Trump's policy, saying that the markets are underpricing signs of a deal, saying that the deal is more likely to happen, then that is helping Trump by saying that. So he must have been biting his cheek the whole time, like, oh, I guess the deals markets are underpricing it, and Trump actually did a good job. But Mr. Griffen, look at our accounts. They're up like 30% in the last couple of months. Yeah, I know. But Trump's behind that. I know. But don't you hate Trump? I know. We're like, yeah, but look how much you made. I know. We're like, I know. It's okay, man. You'll get there. My friend. It's after being conditioned by the media, bad orange man bad for like 10 years straight, you can't expect them to just go cold turkey. So we got to give them some time to decompress. Put yourself in their shoes. You've been bombarded with hate about this guy. It wasn't even true the whole time. And then he's like helping you so much that you can't even deny it yourself. So it's like, and then you got to go eat crow. Well, you don't have to eat crow, guys. Look, all you have to do is just show respect to the people that you may have pissed off. And they understand. They know that y'all got brainwashed into this bullshit. Okay. So just show them the respect and they'll get it, and you don't even have to say anything about it. Better that you don't. Just be cool, and they'll be like, oh, and they'll, give them the nod, and they'll understand. Because, people, at the end of the day, people, even if you're Democrat or whoever, people are people, okay? It doesn't matter where you go, and corruption is corruption. And at some point, you got to draw a line. Are you going to be part of that or not? And if you acknowledge the foolishness, then that makes you complicit. And so don't be part of that, folks. Instead, focus on what's important. The markets right now are facing inflationary pressures, for instance. So we got the St. Louis Fed, who is a Trump supporter, basically stating that that he is recommending a policy counter to what Trump is wanting. Trump wants the Fed to lower rates. Remember how the Democrats are making such a fuss about Trump pressuring Jay Powell to lower rates. Well, I mean, if you do the math, right now it's unsustainable. If you go to cbo.gov, the Congressional Public website here, cbo.gov is the bipartisan website. And you look at the trajectory of the debt, or just look here, look at that, projected. That is not sustainable. And so if we continue on this path, nothing doesn't change, then it's going to be bad. Trump is the game changer here, and so but he needs Congress to start cooperating. He needs the Democrats to get on board, and these are things that are pretty universally agreed upon in the polling, but the Democrat leaders are not honoring the will of the people. They're instead putting their own interests ahead of the people that they pledge to put first. And then, I mean, how can they have a problem with America First policy? That's the definition of a fiduciary, literally. I'm a financial advisor. We are fiduciaries. So, when we make decisions, we're putting your interests ahead of our own. So how is it that the politicians who have way more power than I do blatantly put their interests ahead of others in egregious ways? You name it: fraud, bribery, lying, brainwashing, gaslighting, the list goes on. These antics are just childish at this point. And so if an advisor were to do anything close to that, they'd hang us from a rope, metaphorically speaking. Yeah, but these politicians just, do it with impunity, and that's got to stop. We cannot let that fly. We cannot allow a precedent for that to occur. And, the Democrats, they want that now, but the shoe were on the other foot. They'd be wishing that the other party would be so graceful. So y'all should think about that. But in the meantime, the Iran situation is not going to resolve anytime soon. Even if they had a ceasefire deal right now, it's going to take at least a year for them to get a lot of those wells back online in Iran and get the global shipping to reorganize its logistics. It's to sink it back into it. In the trade deals that Trump has made with China, like all the oil that we're going to now sell them, that Iran is not selling them, which is a boon for our economy. Well, that's going to change the trade routes as well. And so a lot of that has to settle, and that's not going to happen soon. However, Ken Griffen is an insider, and when when I say he, Citadel Securities, says that the market's underpricing it, then you can probably bank on that in the near term, that the market's probably going to rally. And then what else is there? If you are a forex trader, the Japanese yen is knocking on the door of 160, and that's when the Bank of Japan historically would intervene to make sure that their monetary policy for Japan is normally what they call a carry currency. So when you buy a currency pair, because currencies are traded in pairs, like the yen is really Japanese yen to US dollar, or US dollar Japanese yen, USD, and then the fraction, then JPY. So when you buy that fraction, you're going long, or you buy it, the numerator is long and the denominator you're actually short. So if your USD is in the numerator and yen's in the denominator, and you go long that pair, then you're actually long the US dollar, short the Japanese yen. So even Japanese yen at one time had a negative interest rate. So when you went long the yen, US dollar, Japanese yen pair, you actually got a positive credit. And that's why they called it a carry trade, because you can borrow from the yen essentially to buy the US dollar. And so the Japanese yen at some point got to keep inflation at bay. And they want, now that they finally have some inflation after 30 years, because the Japanese yen, the Japanese economy got their GDP to debt level up to 250%. And normally that would crush an economy, but Japan holds almost all of their debt internally inside their government. So they can go and restructure it, so many ways. So, and then Japan has been, the hub of global trading for so long. It's such a carry trade established in the system, and being a staunch ally of the United States is tied to the dollar in many ways. So, all that being said, for you bottom liners out there, inflation is probably going to persist some more. So you want to hold hard assets. My advice to you, this is generalized advice, be sure to consult your advisors specifically, but hard assets should be a good hedge against that inflation. Hard assets as in like real estate, for instance, gold maybe, even a little bit of Bitcoin. But I know that I myself have been investing back into my own home. If you see my other videos on home improvement, that's one of the main reasons why I'm doing it, because this inflation is just going to drive home prices, and with all the immigrants that came into our country, the housing market was already under pressure. Before that, there was a shortage of homes. And then with all these new people here now, it has just gotten even worse by a order of magnitude. That means real estate has market supply shock, inflation pressure, and then it has inflation pressure from oil, and then it has inflation pressure from monetary policies like debt. And so that's a triple whammy. So I advise you consider doing some home improvements in your house, or even buying a real estate fund inside your 401k, like TIPWX is a total income Blue Rock real estate fund. Normally, you would need $1 million minimum to get into that fund. But if you have an independent advisor like me, I can aggregate all the smaller accounts to add up to $1 million, and then I can get access to it. And so for these products, you want to make sure you consult your advisor, because they're not as liquid as a normal stock is. Normally, they only allow a certain amount of liquidation once a quarter. And so normally you can liquidate your whole amount. But if there's a lot of people selling, sometimes you can only liquidate half of it and then get the half the next time. But I never had it to where someone couldn't completely liquidate it over a 6-month period. But that is considered what they call private equity business. And the private equity market as an institutional investment strategy has been like way oversold lately for the last 10 years. And so you got advisors like me looking at bonds right now, and treasury bonds aren't paying jack. Yeah, they've gone up. They've gone up for a long time, but for a long time they didn't, but they're still pretty low. So if you account for inflation, I believe there's a negative return up the yield curve until you get to like the 20-year almost. And so people are saying, well, we need income, especially with the aging economy. Most people are retired now who have the portfolios that advisors manage. And so they take a chunk of that bond section of their portfolio, slice up a chunk of that, and then they'll put it into these funds, because these are retirement accounts meant to generate income. So they're going to hold on to them for, a longer time period. And so the point here is that, you can get a bond yield equivalent to maybe 10% with a risk level of 30 out of 100, which is in the conservative realm. And so to get a practical, it's not guaranteed, but these are income payments, so they're stipulated by contract. So they're practically guaranteed for income. They're suitable for retirement income. They're generating 10%. So that you can't get 10% in a treasury bond. You can't get it in a CD. You might be able to get that in a fixed annuity product through the insurance company, and I do sell those. And sometimes we take a little bit of fixed products, and then we take these private equity real estate products. And so the bond section, say someone is say they're moderate, 50% bond stock, for instance. That 50% stock, we might pitch 25 of it into a fixed annuity. Then out of that, the 25 remaining, we might put 15 of that inside the real estate fund, and then the rest of it we might have in cash or bond funds, diversified bond funds, and so that acts as a high yield liquid portion of the portfolio, so we can act on opportunities. Yeah. So I watch the markets all the time as additional insurance to my clients, but also insurance can also mean not just protecting from loss, but protecting from missing an opportunity for gain. So for my younger, more aggressive clients, they have FOMO. That means fear of missing out. Even older clients have that too, but as you get older, your priorities change. You don't have time to recover from a loss, so you're not interested in FOMO as much. You're interested in capital preservation and income. But FOMO, like for instance, I saw that. Remember when GameStop went through the roof? Bloomberg came out and said, "Hey, look, there's a 400% short ratio on GameStop." And I've been watching the news, and I know that Reddit had congregated a massive following around. It was what was it? I forget his name. He had a funny name. It was like. Anyways, it'll come to me. He was a trader on Reddit who would post his trades and he would buy stocks that are highly, what they call the highly shorted stocks. And so, some companies, all they do is short. That's their specialty. And so they'll look for companies that are questionable, that are overpriced. And there's so that they start getting a popular names, people start shorting them. So you just Google most shorted stocks, and GameStop was consistently in that list. And so GameStop just also because people who go on Reddit are GameStop patrons, so it was a natural match for them. So they were just on it. And so when you have a short ratio greater than 100%, basically you when you have a short ratio greater than 100%, when you have a short ratio greater than 100%, then that means that more than 100% of the stock outstanding, like in the market or held by someone, is being shorted by someone. So they borrow the security and sell it, hoping to later sell it back at a lower price and then earning the difference. And that difference is the profit they make from the short. But in order to cover your short, you have to go back into the market and buy that stock back from someone in the marketplace willing to sell it, and then cover your trade and hopefully make a profit. Now, covered, if you cut a covered short, you would actually hold that stock in your inventory, maybe in a separate account. And then when you want to cover it, you just cover it with your own inventory. And that's the most safest way to do it, because you get in a situation where you're at maybe 75% short ratio and then it gets up to over 100, you don't even know. That can escalate quickly. And once the price tanks or shoots up, all it takes is someone on Reddit who has, a $10 million following on there, which, in social media is pretty common. And then their leader comes out and says, "Buy GameStop!" And everyone gets on their phone. Whew. Slow motion time. Tick, tick. Stop. Flashback. I'm a Reddit trader. Oh yeah, they said to get a Robinhood account and then buy a call option on GameStop with the $500 stimulus check I got in the mail. What does it says here? And notional value of $10,000. So $500 deposit on my Robinhood account can buy me a $10,000 notional, $10,000 worth of GameStop shorts. Yes, sir, that is correct. Oh wow! So if I multiply 10,000 by 5 million Reddit followers, that is a lot of people buying. That's going to shoot the price up. And then all those 400% short are going to have to cover their trade or face unlimited losses. And in the frenzy of buying back that stock, every buyback is going to bid that price up. And when it gets bid up into infinitum, then everyone, it just escalates further because the more pain people see it go up, the more they're going to want to cover that trade because they see the losses. And so that's why GameStop just went boom, boom. So when I heard that, I went in, I'm a financial advisor, put my clients' interest first fiduciary. These are client accounts. A lot of them retired. They can't afford a big loss. So I'm only putting in I think 0.5%. We're looking at 0.5% of 15 million though, still about $500,000. But that's a lot of money. But divided up amongst all accounts, 0.5%, that's a daily fluctuation. We don't take it for granted, of course. We take it seriously. But on an opportunity like that, I think clients would be obliged to risk 0.5% of their portfolio for what is basically almost a guaranteed opportunity. It's going to go up at 400% short ratio. So I dropped it in, and then boom, boom, and it skyrocketed. I was like, my heart's like, it jumped up to about $5 million. And then all of a sudden, Bloomberg came out and said, they're starting to shut down the platforms because that whole payment for order flow thing, Citadel, was involved in, and Schwab. And so basically they didn't disclose that new trading platform created systemic risk. And so they started shutting down everyone's accounts. And then all these retail traders who had got it in later on in the jump got left holding the bag. But I got the heads up from Bloomberg. And so I was like, oh, every millisecond was like an hour. I was like, oh, and I saw the price just coming down. People were closing it. They knew it was coming. And I was all cashed out about $3,500,000 off of 500,000. And my clients were like, whoa. I was like, yeah. Well, anyways, I should make a whole video on this because this story gets even more interesting. You will not believe it. And now that there's new people in power now, I can tell the story without having to worry about retaliation, which they tried to do on me and was successful mostly. But, better luck next time. You can't snuff the rooster, baby. Can't hold a good man down. Don't shoot the messenger because he shoots back. Anyway, back on track. Drop my pen here. I need my pen. Okay, so bottom line. Market shaking off Iran. Oil is already pushed prices up across the board. And after oil prices get set, we got the St. Louis Fed, who's a Trump supporter, going against Trump's policy on the Fed lowering rates. So it must be a tongue-in-cheek move. We got the yen on notice by the Bank of Japan knocking on the 160 level. So if you're a yen trader, watch out for that. I would if you're sitting on gains, just take them. Don't be greedy. That's what I had the guy who taught me to trade. He's an Arabic guy. He would always say, Christ, take what the market give you. Be happy that you made money. I was like, yeah, but I barely made anything. And he said, but you didn't have a loss. When you go fishing, you not always catch fish. But when you do, always be grateful. And I was like, yes, sir, I understand. And so the point was, don't be greedy. Just be happy and take what you can while you got it. Don't try to fight it. Make choices based on good decisions, informed choices, and not off of emotion. And you'll do okay. So bottom line here is take profits on your yen trades and your long-term portfolio or net worth. If you look at your net worth as an overall portfolio, like you got your stocks and stuff, then you have your real estate, and you may have a business, rental properties. Get some real estate in there. Improve upon your existing real estate. Consider taking a position in Bitcoin and gold, and talk to your advisor or contact me if you want to. And I have a minimum of $100,000, just FYI. And contact your advisor, whoever it may be, if you need one, talk to me about adding, diversifying the bond section of your portfolio with real estate. And the form of that could be, a virtual fund where you own equity in a fund, or outright ownership of real estate, or your existing holdings of real estate. Add to that trade, and do a home improvement on your house right now will yield great returns right now. You're going to get stock market returns on an investment that averages long term like about 5 to 8% over the long term, but it's a consistent 5 to 8%. If you take portfolio A, who has say portfolio A has 10% the first year, 15% the second, 30% the third. In year 4 it has minus 40, and then in year 5 it has plus 40. You think you're breaking even, but in order to break even, if you have a 50% loss, you have to make 100% gain just to break even. Say you had $1,000, it drops down 50%. You now have 500. If you go back up 50%, you're only up to 750. You have to go up 100% just to get even again. And so if you have a consistent 5%, that's better than an inconsistent higher return if your sequence of returns lands you at a time frame where you're not able to recover. And so you need to contact your advisor about that. Don't try to wing that, because what happens is most people are making, if they're going to do it themselves, make investment decisions based on media. And usually that media is not the right kind of media. It's in the right kind of media, they wouldn't understand the language, the nomenclature, the jargon. And so that's why I think people say, well, if Bloomberg, you can just watch anyone can watch Bloomberg and get the trades off there. Why do they need you? I was like, because go in there and tell me if you can explain this stuff. No one's going to explain it. No one can even if you want to. Are you going to put $100,000 of your $500,000 portfolio into an investment that you're not completely sure about? You're just going on what some random person on a financial media program said without verifying that first with someone? No. You're not going to buy a house and go use someone else's appraiser. You're going to get your own appraiser and avoid that conflict of interest. And so that's why you have an advisor. Even the greatest athletes out there still have coaches. I can think of a few off the top of my head. Anyways, bottom line is hard assets, inflation probably going to persist in spite of Iran. But Citadel Securities, Ken Griffin's saying the markets can continue, and then all that money from the big beautiful bill, all that stimulus is still sloshing around the system. So we still got that as a tailwind. And then the $19 trillion of money, foreign direct investment from Japan and other economies that Trump has negotiated in these trade deals. And then the almost $1 trillion in tariff tax revenue. And then the almost $1 trillion that we saved in fraud that we've uncovered in the government from Doge. And then the $380 billion barrels of oil that we got from Venezuela after we took out Maduro. And then the trade deal to sell oil to China after we took out the Ayatollah in Iran to China. All that combined is a recipe for up everything. So unless something crazy happens, heaven forbid, you should stay long your portfolio with your finger on the trigger, with your advisor on your speed dial on your phone. Okay, because markets could reverse quickly if things escalate. Just look at, history is not, guarantee any, we always say that, history doesn't guarantee future results. Past doesn't equal the future, y'all. I know, common sense, but apparently it's not common anymore, so we have to say it now in disclosures. But just look at here, World War II. Look at that. Boom, it jumped up, everything was cool, and then blah, blah! Well, take this right here, and then zoom in on this, and that's a fractal of this right here. So this little ledge is actually, this one here zoomed in from an exponential thing. So see this, is it kind of drawn here? Oh, yeah, I can. So this right here is this right here. See what happened next? So this was a realistic, very realistic problem. However, with Trump being in office, and yes, I support Trump. That's not obvious by now, but it's really, I support America. He's just a messenger. Don't shoot him, y'all. And he shoots back. If the Ayatollah, Maduro, the Mexican cartel, just to name a few. Need I say more? But we don't need this to happen. I don't think that's going to happen. Trump's in charge now. It had to take a outsider, someone without a conflict of interest, to stop this 40-year government leaders doing nothing on both sides of the aisle. You got these rhinos in the Republican Party, and I bet you they're on the take also, like Thune, for instance. So they're fleshing them out. It's needed. It's time. But we don't need this to happen. If that happens, it's going to get ugly. We're talking 2008 ugly. But I don't think that's going to happen because everyone's on board. Trump won. He didn't just win. He won. Popular vote, every single state, every district. He won. So you Democrats out there, cut it out. Get on board. There's so many bigger problems than your pronouns. Like this debt situation here. That should be the number one subject. We should be working together to work on that debt. Anyway, I'm not going to lecture y'all because that's just going to make you want to do it less. But instead, say, don't you think your time would be best spent working together to stop an impending crisis rather than arguing about things that may not be as... we acknowledge that you find that important. We don't understand it. It's not obvious to us. But who are we to say, right? But it's not that... There's a difference between importance and urgency. If something may be important, but the urgency level is down here, and then you have something may not as important to you, but the urgency level, like, the debt spiraling out of control, and then everyone having an inflation crisis, and at that point, all that wouldn't even matter. And it would be a mute point because then there would be a complete societal breakdown. So do you think it's a good idea to really push these agendas right now when we are facing such a great risk? It's not a good idea, right? So I challenge you, Democrats, if you're watching, to really think about this. In life, you can get everything you want, according to Zig Ziglar, if you help others get what they want. And I believe that. If you help us to pass these policies that will help everyone, we will probably chill out on the things that you want and let y'all be more will be more inclusive with y'all about what is important to you. And so think about that, y'all. Not that I have a huge following, although I should, because this information is invaluable. You could trade on it. You could, and if you follow me, then you could consistently protect your portfolio. If people pay me lots of money to do this normally, I'm just recovering from an accident, and so I kind of fell into this YouTube thing because of compliance, actually. So we had, as a firm principal, I am responsible for the due diligence of the firm. So when we make recommendations for clients, you can rest assured that we did our due diligence. That's why on my firm's logo, as you can see here, I has my signature. That's how you know that we did our due diligence. And so in order for me to make an account of my periodic due diligence, I just put it into YouTube videos. And so people can say, well, how do we know you did your due diligence? I'm like, are you subscribing to my channel? So I get a channel and then I get compliance done. And, so it's easier to talk than write. But, people knew the value of the information I'm giving. I would have way more than a lot of these people on YouTube. I'm not hating on them, but like the algorithm is promoting, like in my professional opinion, low quality information is the YouTube algorithm is prioritizing resources to low quality information content creators and scuttling the ones who are actually providing valuable, high quality content like myself. Yes, I know it's a conflict of interest for self-proclamation, but being that I just showed you, and you ask anyone who has some money saved, this is valuable information. Plus, I'm board certified financial planner. I'm licensed investment principal, a 20-year firm, trading since I'm qualified. And I say that in singularity. And so I wanted to crystallize that in your perception of the services we offer. Anyways, thank you very much. It's been a long talk today, but there was a lot of information here. Feel free to leave some comments. I would love to hear your feedback. If you have any questions, financial planning questions, investment questions, put it in the comments. You will be surprised how much I know. And it's like when I get referrals from my clients, they come in, they got kids my age, right? So they're kind of like, the guy's got his arm crossed, and his wife's kind of like, they're looking at me like, this guy's going to advise us. But then they start talking to me, and I start getting to know them. I start going through the process. They're like, oh my God, what else do you know? And so I've taken the time. Most advisors, they look at your watch and they're like, all right, your hour's up. We'll have to schedule another meeting. Okay. People are like, well, we just kind of started getting into it. That's not how you do it right. As a financial advisor, you take the time, as much time as you need with the clients, because older clients like to go slower, not because they're slow, but because they're actually thinking things through. They have a lot of experience to draw on, and they know things that we don't know, and you can learn from them, from their experiences, stories. And so you got to slow your pace down and listen to what they're saying. And, that takes more than an hour. That takes sometimes several hours. But if you're a good advisor and you take your time and you go through enough clients like this, and you get them set up, you look at all their insurance policies across the board, health, home, life insurance, their employee benefits. You look at their pension plans. You look at their severance packages. You look at their business agreements with their partnerships, buy-sell agreements. You look at their estate planning, make sure they got their trusts in place, their wills done. You look at all that stuff. You do a comprehensive thing for them, and no one has done that. They got, even the most sophisticated clients in my 20 years experience have done, they may have, not saying they don't have good advisors, but they have their CPA that does their books and their taxes. Then they have their attorney who might have done their wills for them or set up their business. And then they have maybe a realtor here, a mortgage person, a banker, whatever the case is. They have their advisors, but they've it's like a patchwork quilt put together. No one's taken that quilt and then streamlined it into an overall pattern and to make it what we call a synthesis of magnificence. And all that starts is by crystallizing your objectives as it relates to what's important to you, your values, your family, your business, et cetera, et cetera. And then we look at where you stand now in relation to where you want to be. We confirm that into a written letter to which you and or your spouse can review and then come back to us with any corrections, as oftentimes my experience and the way I ask questions will get you thinking. So sometimes it doesn't process right away because there's a lot to take in a small amount of time. So overnight, sleep on it, and then you and your spouse in the morning are like, oh, wow, and then you'll have a whole list of questions. That's what financial planning is about. And once you've done that with enough people and you set them up, those clients are going to be there for you for a long time. And so a lot of my clients are still at Schwab and some of the other custodians, and I'm still moving them over into my firm. But I will be, at some point, I won't be taking on new customer accounts. Or if I do, the minimum will be much more than 100,000, that's for sure. So I'm not actively marketing my firm right now. I'm referral based, but I will answer questions. And if I see that you are someone that would be a potential candidate, once we get our firm documents updated, because we're going through the process right now with our registration, then we can provide them our disclosure document to you so you can review it and decide if it's an advisory firm that you would want to hire to provide those services for you. And we'll keep you updated. But anyhow, thank you very much for your time. I know this has been long-winded, but this is important information to know if you're going to be following my channel, if you want to get the value out of it that can be derived. Feel free to comment and question me in the comments. Give me a like so it helps the algorithm. And don't forget to subscribe, of course. We put the notifications on that if we get another opportunity like GameStop, I can do a quick alert and you'd be like, oh, shoot, if you're someone who wants to jump on opportunities, or if I say, hey, you might want, it's time to dial back the risk in your portfolio, you might want to call your advisor and say, hey, this guy on YouTube is saying, oh, yeah, we might want to do that. You get your advisor to rebalance your portfolio into a lower risk portfolio. So there's value to be had here. So subscribe and share with your colleagues, friends, and whoever. We're never too busy for referrals. Once again, this is Christopher Whitney, KW Podcast, signing out. We'll see you in the next one. Peace.